When it comes to the election and stock market returns, a lot of people didn't like Obama, and they got out of the market. The market went up tremendously. A lot of people didn't like Trump, and the market still went up a lot. A lot of people didn't like Biden. The market still went up. That's the point here, is that historically speaking, it doesn't typically really matter who's in the office. I mean, the ultimate scenario historically, if you want to look at it, is a Democratic president with a Republican Congress is number one, up 16.9% on this whole docket here. And then if you go over to the right, you get a 13.7% increase with a Republican president and a split Congress. So very interesting there, but again, you can see it's not a tremendous amount of difference of return on it. And I mentioned this before about it's not really politics, who's on what side, really what are the policies? And number one, what kind of innovation is going on? We got AI going on right now. What's going to be the next big innovation? Are companies making profits there? Are we able to adapt to crisis situations, which historically humans have been able to do? So new products, new ideas have typically driven the markets historically higher and higher and higher over time. And that's what we're seeing right now with this AI situation. And this is an interesting chart here showing if you had invested 1 million as a start point. So it grew to 32.5 million since 1950, just investing. If you just wanted to invest under Democratic presidents, 3.12 million, Republicans 1.04. So for what it's worth, again, just investing and not necessarily worrying about things has historically been no guarantees going forward, but that's what it is. And then historically, when it comes to a presidential cycle, the fourth year of a new president, he's in his fourth year. It's a new president. It's not a lame duck where he's going out. We got to elect two more presidents. But if you look at this, in a fourth year of a new president, the market historically has done the best in that second half of the year, which is where we are right now. And then historically, bull markets may last longer than you think. The average is 61 months. We're only at 20 months right now compared to the returns on the upside. This really gets into, guys, what I was talking about before is setting up your different buckets of money for that first, say, 15 years that are more conservative, if you will. Again, may not be appropriate for you, but historically have that safe money. And then you have that money that's longer term growth when you get out here, 15, 20 years, you're never going to touch probably, looking to strive to get growth and maybe some downside protection on that too. And then finally, again, back to this, is striving to find what is going to be the best horse, who's going to win. Nobody knows for sure. I mean, they could get 3/4 of the way around the track and they get hurt. They might be winning now, but maybe something happens cause them to go down, or they start going backwards. And do you have the proper plan in place to protect in different market scenarios, economic scenarios? If you want a second opinion, give us a call. We appreciate all our current clients' business. We appreciate you. Thank you for your trust over the years, and look forward to catching up with you in the second half of the year and talk with you. All right, thank you very much and have a great rest of your day. And now we're going to roll our disclaimers so you can see that as well. We appreciate it. Thank you.